Money is widely accepted as a medium of exchange in transactions. Money is essential for buying goods, services, and making loans, and it measures wealth. Banknotes are commonly used as a medium of exchange in transactions that circulates from one person to another person. Before money, people used bartering to trade goods they needed. Bartering required both parties to want what the other had, which made it inefficient due to the lack of transferability and divisibility. Money solved barter issues by simplifying transactions. It saves time and effort, allowing people to buy directly with cash without matching needs.
To begin, let's define money. Money can be described as anything that generally accepted and fixed as exchange of purchase a good and service. It plays a crucial role in facilitating trading and serves as a backbone of economy.
Hi everyone, my name is Ting. I'm going to explain about the characteristics of money. The first characteristics of money is measurable. That money can be assigned with some value, yaitu wang boleh diberikan nilai yang tertentu. The second characteristic of money is divisible. Money can be divided into smaller units without decreasing its value, yaitu wang boleh dibahagikan kepada unit-unit yang lebih kecil tanpa mengurangkan nilainya. The third is portable. Money is easy to carry and therefore is easy to transfer money from one person to another. Maksudnya ialah wang boleh dibawa dengan mudah. The fourth is widely accepted. Money has a standard value that is fixed by the law of a particular country. Maksudnya ialah wang diterima umum kerana ia mempunyai nilai tetap. The fifth is inimitable, which means money cannot be imitated. Currency has security features like serial numbers that prevent counterfeiting. The next is standardized. Each individual's banknotes is of a uniform standard. Maksud wang memiliki bentuk dan saiznya seragam. The last is scarce. Money is in relatively short supply to avoid depreciation, iaitu penawaran wang adalah terhad. Penawarannya dikawal untuk mengelakkan inflasi.
There is four functions of money. First, medium of exchange, a store of value, a unit of account, and a deferred payment. Medium of exchange. Medium of exchange is the barter system which needed the double concept of funds. As example, if you want to buy 1 kilogram of grain, you have to exchange with 1 kilogram of sugar. The system was difficult to implement in a complex economy. The stock of value method money is or delay in purchasing resource for future use. People receive their income in the banking system, such as through saving deposit, fixed deposit, and gold. A unit of account is a uniform unit that provides consistent method of quoting price. Measure of the value of goods and services quoted in monetary units. As example, a book and a tablet are quoted a price of 30 ringgit and 500 ringgit. Each country have their own monetary unit, which is USA use dollar and Korea use won. This function is more useful and easier. Last is the deferred payment. Some transactions in the economy are performed as delay payment or credit. For example, a person purchased a motorcycle at a price of 50,000 ringgit and performed a monthly payment for 2 years and 6 months. This transaction in money which has a stability value.
For this part, I would like to talk about commodity money and fiat money. Commodity money. Commodity money is currency whose value derived from material is made of, such as gold, silver, or goods like salt or cattle. Unlike fiat money whose value comes from government decree, commodity money's value is inherent in the materials. Its value remains stable because it's tied to physical goods with metals like gold and silver, historically favored for their durability, divisibility, and portability. Characteristic of commodity money. The first one is measurability. Money must be measured so that people can assess how much they are willing to pay. The second one is durability. The commodity's intrinsic value must be retained for trust in it to endure. The third one is exchangeability. Commodities that have historically passed on are convenient and easily traded. The last one is rarity. Commodity money must be rare in that the supply is limited. Historical of commodity money. It began around 7 to 500 before Christ with electrum and was used earlier in Egypt and Mesopotamia. After World War II, items like gasoline and cigarettes acts as money in Europe due to shortage. It evolved from bartering, simplifying trade by using a common standard. Puritans in Massachusetts used farm goods as money, with the government set price for tax payments. Issues included low quality goods, spoilage, and high transportation costs. While useful, commodity money was inefficient, leading to the creation of modern currencies. Fiat money. Fiat money is government-issued currency not backed by a physical commodity like gold or silver. Its value depends on supply, demand, and government stability. Most modern currencies like the US dollar and the euro are fiat money. Unlike earlier currencies, fiat money can be exchanged for anything physical and can lose value due to inflation or hyperinflation. If people lose trust in it, its value decreases, unlike gold, which maintain value due to demand in jewelry and industry. Characteristic of fiat money. The first one is durability. The physical durability of fiat is an important consideration. The second one is portability. How portable money is will determine is suitable as fiat currency. The third one is divisibility. Fiat currency needs to be divisible to act as a unit of account. The fourth one is uniformity. A $10 bill is always the same size, shape, and value. The last one is limited supply. Fiat currency needs to have a mechanism controlling the supply of money. Historical of fiat money. The story of fiat money begins in ancient China, where necessity drove innovation. During the Tang Dynasty, shortage of precious metals led to the use of paper credit notes in trade. By the Song Dynasty, copper shortage influenced private merchants to issue the first legal tender paper money. Under the Yuan Dynasty, paper money became the only legal tender. Later, during the Ming Dynasty, it was formalized by the Ministry of Finance. By the 18th century, American colonies and France adopted paper money, but overinflation caused inflation. During the Civil War, the US issued greenbacks, suspending gold convertibility. By the 20th century, economic pressures ended commodity backing. The 1944 Bretton Woods Agreement tied the dollar to gold. By 1971, President Nixon ended gold convertibility and leading in modern fiat money. Today, fiat money backed by trust, not gold, drive global economies and trade.
Money supply is the total cash, coins, and easily convertible assets in an economy like banks' deposits. It helps monitor economic health, detect issues, and guide policies as it affects inflation and interest rates. There are three types of money supply in Malaysia. The first one is the transaction approach, which is M1, that includes money used directly for transactions like currency in circulation and also demand deposits. Currency in circulation is notes and coins issued by the Bank Negara Malaysia, excluding amounts held by banks, while demand deposits are current accounts, including Scheme Perbankan Islam (SPI) accounts held by the non-bank private sector, which can be withdrawn anytime and earn little interest. The second one is broad quasi money, which is M2, that is less liquid than M1, as it takes time to convert to cash. It includes deposit and interest-bearing instruments like SPI deposits held by the non-bank private sector and investment banks, excluding interbank placements. Foreign currency deposits cover holdings by residents and foreign entities in commercial and Islamic banks. The last one is M3, which is the sum of M2 and deposits placed with other banking institutions, which is the total deposits and interest-earning instruments from the non-bank private sector with investment banks, excluding interbank placements.
Next, I'm going to talk about financial institutions in Malaysia. The Malaysian financial system has become more organized over time. After the 1997 financial crisis, the government through Bank Negara Malaysia (BNM) helped merge local banks into 10 bigger banks by 2002. The government also encouraged more mergers to help local banks compete with foreign banks. Now Malaysia has 8 local banks. NI is in charge of giving license and overseeing different types of financial businesses such as commercial banks, investment bank, Islamic bank, and money broking. Malaysia introduced Islamic Bank in August 2006 with the launch of the Malaysian International Islamic Financial Centre (MIFC), aiming to become a global leader in Islamic finance. This allowed both local and foreign banks to operate under Islamic principles. The Malaysian financial system is divided into financial institutions, which include banks and non-bank intermediaries, and the financial market, which consists of the money and foreign exchange market, capacity market, derivative market, and offshore market.
Banking system. The banking system consists of Bank Negara Malaysia, Central Bank of Malaysia, banking institutions such as Commercial Bank, Financial Company, Merchants Bank, and Islamic Bank, and a diverse group comprising discount houses and representative office of foreign bank. The banking system is the largest component of the financial system, accounting for approximately 67% of the total asset of the financial system. Central Bank, which is Bank Negara Malaysia or BNM. Bank Negara Malaysia is a statutory body which began operation on 26 January 1959. BNM is regulated by the Malaysia Central Bank Act 2009. BNM is committed to fostering monetary and financial stability. This is intended to provide a variable climate for the sustainable growth of the Malaysian economy. Role and the function of BNM. First, devise and execute monetary policy to effect of regulate money supply and interest rate in the company. Next, issuing currency in the economy. Regulate and supervise financial institutions. Advise and investigate abroad. And last is banker to commercial bank.
Next, let's start with balance sheet. Balance sheet, often represented as P account, is a set and claim statement to summarize firm and commercial bank financial position, and it has two sides, which is asset and liability. Assets are valuable resource that bank own. Meanwhile, liability represent bank debt, which include net worth and deposit. Deposit is loan owned by depositor, and if bank client deposit money in bank borrow money from its client. Net worth is value of the company to its investor or shareholder, or the difference between asset and liabilities. Is value positive if there is a gain, and value negative if there is a loss. So, a positive net worth indicates that bank is profitable, while negative net worth suggests that it has financial difficulty. To understand money creation clearly, we rely on simplifying assumptions. This helps us focus on core mechanism without getting bogged down by real-world complexity. Assumption 1. Required reserve ratio is fixed by the central bank. It determines the portion of deposit that bank must hold as reserve. This ratio is set and regulated by central authority to maintain financial stability. Assumption 2. All asset reserved in transaction will be loaned to bank customer. Assumption 3. All transactions using check and customer deposit are demand deposit. Assumption 4. There's no leakage in banking system. It is assumed that borrower redeposit full amount of loan into banking system, ensuring money stay in circulation within the bank. Assumption 5. Asset only included in reserve required or loan, and liability only involved in demand deposit. This simplifies bank balance sheet by only focusing on components that directly relevant to money creation process. This assumption create a controlled environment to analyzing money creation within the bank. While simplified, they are useful to understand fundamental concept and monetary policy and banking operation. Next, the money multiplier. The money multiplier represents factor by which total amount of deposit can increase in the banking system for every unit added to reserve. Economists use money multiplier to describe how change in reserve translates into change in overall money supply. A lower required reserve ratio increases the money multiplier, allowing more money to be created in economy, while higher required reserve ratio reduces the potential of money creation. But this model assumes no excess reserve. In reality, bank might hold additional reserve for risk management. It also assumes that all loans are redeposited into banking system, which may not always occur due to withdrawal or cash leakage. In conclusion, money multiplier is simplified but powerful tool to understand the potential of banking system to amplify money creation.